Welcome to Capital Link's company presentation series.
Welcome to Capital Link's company presentation webinar series. In this series, senior management of listed shipping companies provide an update on their operations, business development, strategy, and sector outlook. I'm Nicholas Bornozis, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization. We work with several private and publicly listed companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and obviously Capital Link bears no responsibility for them. Today, we have with us the senior management of Pyxis Tankers. We have with us Mr. Eddie Valentis, Chairman and CEO, and we have Mr. Henry Williams, Chief Financial Officer. The whole session will take 45 minutes. We'll start with a brief slide presentation, followed by a live Q&A session. Please submit your questions using the Q&A button at the bottom of your screen. Alternatively, you can email your questions to us at webinars@capitallink.com. Thank you very much for joining, and without any further delay, I'm turning the floor over to Mr. Valentis.
Thank you, Nicholas, and thank you for organizing this webinar today.
So we can start with the presentation. I think
Eleni.
There we go.
Good morning, everyone. We are Pyxis Tankers. This is our disclaimer and our forward-looking statements. Oh. Yep, next. So we are Pyxis Tankers. We are an international pure-play product tanker company. We focus on modern, medium-range MR product tankers with eco features. Our modern tanker fleet currently consists of 5 IMO-certified vessels with a weighted average age of 8.5 years. Also, we have 2 small tankers in the fleet, which we are about to sell. We have long-standing relationships with first-class customers worldwide. And as of January 21st, 36% of available days in Q1 22 were booked for our MRs at an average rate of $13,600 per day. We're positioned to capitalize when charter rates improve, with 3 MRs contracted and under time charters and 2 under spot voyages. We have a disciplined, substantially fixed cost structure, which creates opportunity for greater earnings power when rates improve. We have a competitive total daily operational cost to peer group. We have a balanced debt equity capitalization and enhanced liquidity with longer-lived loans. Strong management team with 100 more years of experience, and very good board members, which consist of respected industry figures with significant experience. The founder and CEO of the company, myself, have a proven track record, and I'm a substantial shareholder of the company. We see favorable industry fundamentals, which create attractive entry point for the sector. We expect a slowdown in net supply growth of approximately 2% in 2022. We have a low and declining MR order book, which currently stands at 6%. And we have a record scrapping occurring at approximately 6% of worldwide fleet of MRs, which are 20 years of age or more. We have a potential global economic recovery with COVID-19 vaccinations accelerating, which could lead to sustainable period of better charter rates starting 2022. The next slide. You will see our fleet, which currently consists of 5 MRs you will see the 5 MRs plus the 2 small tankers, which are currently in the fleet. The next slide. Middle column, our customers. You see we have substantial, very strong relationships. We have substantial names, quality vessels and operations, blue chip customers, and very competitive lending terms. On the right hand column, you will see our current lending banks. Going to the next slide. The senior management, I've been in shipping for more than 25 years. I have substantial skin in the game in the company. And I have over close to 30 years now experience in the shipping business. Henry has joined us since 2015 and has substantial investment banking positions in the past. Next slide. Pyxis Tankers is serviced by 2 managers, one affiliated company, Pyxis Maritime, which is doing the admin, commercial and ship management services, and International Tanker Management, which is a third-party manager and is doing the technical and crewing management for us. Next slide, please. So the company strategy, we want to focus on quality, growth, service, and financial flexibility. We will focus on the acquisition of IMO 2-3 MR2 vessels, product tankers of 10 years of age or less, built in first-class Asian shipyards. We will continue to prudently grow the company size as soon as practical. We will meet charter's preference for modern and eco tankers, which offer more operating reliability and efficiency, plus lower bunker fuel consumption. We'll continue with high standards, ensuring high level of safety, customer service, and support. We maintain solid margins and ship-level financial discipline within Pyxis. We will utilize the portfolio approach to commercial management by having a spot exposure plus period employment for our vessels. We will diversify the charters by customer and staggered duration. We will maintain financial flexibility and support ESG standards. We will expand the fleet by targeting balanced capital structure of debt and equity. And of course, we will maintain commercial lending and expand our capital market relationships. Going to the next slide. We support good environmental and social governance standards. We focus on eco-efficient modern MRs, resulting in improved fuel consumption and lower greenhouse gas emissions. We comply with all regulations, IMO regulations, including ballast water treatment systems, compliance with US Coast Guard G8 guidelines, IMO 2020 compliant fuel regulations, and we monitor and report vessel CO2 emissions as required. We outsource our crewing and technical management to ITM, which is part of the world's largest vessel management group, which is committed to maintaining the highest standards in health and safety by ongoing training and development of its staff and vessel crews. Governance, regular election of process for our staggered board of directors, independent board members chair various oversight committees. Going to the next slide. Recent company developments. 2021 has been a very active year for us. By mid-2021, we have completed attractive debt refinancing for our Pyxis Epsilon with new bank debt raised, which we raised over 31 million and we raised 31 million in equity offerings to strengthen the balance sheet, enhance liquidity, lengthen the average debt maturities, reduce interest cost, improve share float, and fund further vessel acquisitions. On July 15, we completed the acquisition of a 2013 built MR, eco-efficient MR. In connection with this acquisition, we closed a loan transaction with a new lender. and they provided 13.5 million of a 7-year secured loan at very competitive terms. On December 15th, we completed the acquisition of another MR, a 2017 built South Korean vessel, which is named Pyxis Lambda. This was bought from an affiliated company for 32 million. The purchase consideration consisted of 26 million in cash, 3 million in a promissory note, and 3 million in shares. The purchase of the Lambda was substantially funded by one of our existing banks under a new 5-year, 29 million secured loan, which also funded the repayment of the outstanding loan of the Pyxis Malu. On January 4th of 22, we announced the signed agreements for the sale of our small 8,600 deadweight vessels, the North Sea Alpha and the North Sea Beta, for a total of 8.9 million, with closing scheduled late January to late February 22. After repayment of existing bank debt and transaction costs, the estimated net proceeds of 2.8 million will be used for working capital purposes. We have no scheduled bank loan maturities until 2025, and our next special surveys to occur are in 2023 for 2 vessels. Going to the next slide. Let me briefly take you to the product tanker industry, the market update. Despite the recent Omicron variant outbreak, demand for refined petroleum products seems to be holding up better than expected, except for jet fuel. Effective distribution of vaccines, as demonstrated by the US and the EU, where 63% and 69% respectively of the populations were fully vaccinated by mid-January 22, positive trends in economic data regarding personal consumption and industrial activity should further increase demand for petroleum products. Expanding global economic recovery and greater personal commercial activities have resulted in crude oil inventories falling to below pre-pandemic levels. In fact, OECD oil and fuel stocks recently fell to the lowest level in 7 years. Despite the uptake in charter rates in November 2021, improving charter rates were short-lived by early January due to the impact of Omicron. Continued export restrictions by the Chinese government, rising COVID variant cases restrictions, and slight economic slowdown has been partially offset by seasonal fuel switching, leading to more imports from the Middle East into Asia and Western Europe, and a slight increase in ton miles. Despite a slightly better crude tanker market, delivery of some new build large tankers such as Suezmaxes, which can carry clean products on their maiden voyages, continue to temporarily add capacity and extend rate pressures into the product tanker segment. The next slide. New COVID-19 variants, reintroduction of restrictions in certain countries, uneven distribution of vaccines, especially in LDCs, and commercial supply chain disruptions have resulted in a bumpy economic recovery worldwide. Following a significant rebound in 21, the World Bank estimates that global economic growth will decelerate in 22, but rise 4.1%, followed by an increase of 3.2% in 2023. The effects of the Omicron variant, supply chain constraints, and inflation are the primary negatives to the global economies. By 23, all advanced economies will have achieved full output recovery, with emerging developing markets still below pre-pandemic levels. EIA estimated global consumption of oil averaged approximately 97 million barrels per day in 2021, and a further 3.6 million barrels per day increase forecasted for 2022, which should result in a return to pre-COVID levels at approximately 100 million barrels per day. OPEC Plus cutbacks are expected to be fully unwound by this fall through monthly production quotas hikes. Consumption should be supported by restocking of depleted inventories. Continued high refinery throughput and greater transportation activities are positive signs. US refinery utilization ran over 88% in early January. IEA estimates global refinery runs to increase 3.7 million barrels per day in 2022, and ISH market forecast an increase of 3.7% in worldwide sales of new light vehicles to 82.4 million units this year. Historically, seaborne trades of refined products have been correlated to global GDP growth. A leading research firm recently estimated growth to seaborne trades of refined products at 7.1% in 21, with a further 5.1% in 22 to approximately 1 billion tons. In the next slide, recovery in demand still on the horizon, with longer-term product tanker demand further supported by increasing worldwide refining throughput and capacity additions, led by Middle East and Asia, leading to ton-mile expansion and growth in petroleum products exports from the US, Middle East, and to a lesser extent, China. In 2022, key demand growth is expected for road transportation fuels and petrochemical feedstocks. 4.6 million barrels per day of new refining capacity scheduled for completion in 2022, substantially all non-OECD, according to Weber Research. Uneven economic recovery, geopolitical events, extreme weather events, and varying global refined products inventory positions could create arbitrage opportunities and add to spot chartering volatility. Next slide. Let me briefly update you on the supply outlook. It's a very attractive long-term supply outlook. That there's declining MR order book. Approximately, as mentioned before, 6% of worldwide fleet is on order. We've seen very low new ordering, which is continuing. We've seen delays in new MR2 scheduled deliveries, which is expected to continue. Extensive construction backlogs at Asian shipyards, led by container ships and bulkers, have pushed out potential new tanker delivery slots into 2024. Of course, the new ship and engine designs, rapidly escalating construction costs, stricter environmental regulations, evolving selection of potential lower carbon fuels, and the scrubber debate further complicate new ordering by owners. With also another positive sign is the increasing of demolition levels. We've seen for the first 9 months of 2021, 32 MRs being scrapped. And overall, let me tell you that 24% of worldwide fleet of 680 MRs are 15 years old or more, and 6%, approximately 100 vessels, are 20 years plus. So we expect MR2 net supply growth to be approximately 2% in 2022. Next slide, please. Just to give you an idea of the vessel values, we've seen robust vessel values in the last few months. The new building prices for delivery early 24 are approximately 41 million as of January this year, with a historical average of 35 million. This is a difference of 17%. And the standard 10-year-old MR, 19 million in January 22, with a historical average of 17.4, and this is a 9% increase. And with this, Henry Williams, our CFO, will discuss the financial details of the company.
Great. Thanks, Eddie. Let's move forward to slide 18, please. Okay. What we have here is the unaudited 9-month results for 2020 in comparison to 2021. As Eddie highlighted, 2021 was a very difficult period of time in the chartering environment. Whether it be time or spot charters, rates were substantially lower. You can see that the time charter equivalent revenues here dropped roughly $2 million in the 9-month period for 2021. That you can also see the revenue mix. There's a little bit more spot activity that we had during this period of time. We chose not to enter into longer-term time charters at depressed rates, and therefore had to participate in the spot trading environment. The daily time charter equivalent rate for the entire fleet, including the small tankers, was obviously substantially lower by the tune of about $2,500 per day. Net, that basically tough chartering environment resulted in lower revenues, which flowed through to the bottom line, net loss and adjusted EBITDA. But at the same time, that was also a little bit more pronounced from the standpoint of the loss, primarily due to the fact that we brought online the Cartiera in July of 2021, and there's certain startup costs associated with that vessel. So with that, let's move on to slide 19. What we have here is the capitalization as of the end of September of 2021. Clearly that has changed given the fact we acquired the Lambda in December. We had also a refinancing of the Malu, our 2009 built Eco modified unit. You know, the reality is there's a little bit more debt, but at the same time, the cash position seems to be reasonably consistent with the past. So, you know, the historical net funded debt was approximately 44%. If you sort of roll forward it and made certain adjustments, and that would be the additional debt that we acquired for the Lambda, at the same time factoring in to a loss, non-cash loss on the sale of the two small tankers, which would be approximately $2 million. The net debt to funded total capital sort of today, factoring in the cash that we're also going to get from the sale of two small tankers. The first vessel will be delivered to the new owners very shortly before the end of this month, number one, and number two, the second vessel is looked to be delivered sometime by late February. But if you'd make all those adjustments, you get a net funded debt that'll approximately be about 53%. Moving forward, our bank debt has a very attractive profile from the standpoint of amortization. We have no bank debt maturities for 3.5 years, which is great. The average interest rate for the company roughly is about 4%. So it's a very, very attractive amortization debt profile for the company. Let's move on to the next slide, please. Here's the here's the shareholder base for the company as of January 21st. As you can see, there's approximately 42.5 million shares outstanding. The float is approximately 19.3 million shares. The balance is held by management of the company. The symbol is PXS. Some important elements you should know. The float is substantially all retail investors. The average volume for the last 3 months has been just under 300,000 shares traded per day. You should know that the current market cap, unfortunately, is total market cap is $17 million. Based upon the net asset value of the company and book value, we're trading at on an average discount of over 65%. So it's you know, a very cheap stock at this point in time. You should also know that there are 3 research analysts that follow the company. Univest, the analyst there, has known the company for many, many years. Noble Financial, Pofrat, follows the company, and VRS, which is a European institutional research firm, also follows the company. 2 of the 3 firms have buy recommendations. The average price target over the next 12 months averages to be $1.28. So obviously we're trading at a huge discount to that price target. You should also know that there is a dividend paying security. We do have convertible preferred shares that are outstanding. We have roughly 450,000 preferred shares. Those currently are providing a cash yield based upon the dividend pay, which is monthly, of a little bit over 13%. There is publicly traded warrants, so there are a number of ways to play Pyxis, whether you are interested in the common stock or the convertible preferred stock. With that, let me move to the next slide, which is the wrap slide, and slide 21. This is Pyxis Tankers today is well positioned for a recovery within the product tanker sector. I think you will clearly have appreciated the fact that we have a very attractive fleet of eco-efficient, eco-modified MRs with runway that's basically 2/3 of their remaining operating life left. We have a very good customer base. We use a mixed chartering strategy of time and spot charters. Obviously, as we move forward with a better chartering environment, which we envision, we'll probably lengthening out our time charters. We have a very competitive cost structure in relation to our peer group, and as you've seen, a balanced capitalization strategy for the company. Management is very experienced and obviously has a lot of skin in the game, to say the least. Longer term, clearly very favorable industry dynamics, which is great for us. So we think obviously now with the stock being beaten up down to roughly 40 cents, it provides tremendous opportunity for potential appreciation. So with that, I guess we'll turn it over to Q&A.
So thank you very much. We have a number of questions that have come in, and I will start. Are you seeing any inflationary pressures to your operations? If so, what expense items and how can you better manage them? What expense items are affected and how can you best manage them?
Okay, I'll step up for that one. Yes, we are to some extent. First of all, let me say, the administrative costs, some of that, is tied into the inflationary rate within Greece. Fortunately, that has not been material for the last period of years, so we're not really seeing it within the Greek economic environment. However, other certain administrative costs, whether they be outside professional services such as lawyers, those are running higher. Crewing costs are also running higher. With a higher cost of crude oil, we're also finding lubricants and certain things like that are related to commodity prices are a little bit higher. Historically, we budgeted very modest increase in OpEx or costs in general. This year, we're taking a tack across the board, basically about a 2.5% increase in our various expense items. Obviously, we try to address these costs as best we can. We're constantly looking at our cost structure. In relation to our peer group of other publicly traded product tanker companies, we continue to be very competitive in total daily operational costs, and that means vessel OpEx, G&A costs, as well as management fees. So the cost of running the business on a daily basis, we continue to be very competitive versus companies that are much larger. So it takes a discipline on a daily basis. Management, again, has 55% ownership of the common, and therefore continues to be extremely disciplined in managing this.
Thank you, Henry. One of the questions that have just come in from one of the analysts who follow the company, we have seen a few false starts with spot rates firming, but then fading quickly. With the winter market well underway and spot rates below cash break even, when do you believe we might see a sustained recovery in the product tanker market?
That's a very good question, actually, which I'm sure nobody can answer because, as you know, our trade is very much dependent on the COVID situation and the pandemic situation. As mentioned earlier in the presentation, we've seen November rates being starting to pick up. That was before the Omicron variant struck, and unfortunately, this distracted the whole the market, and the rates started falling again. So unless we see that the vaccination program is fully underway, and unless we see that the pandemic is turned to an endemic, we cannot be certain that we will see a sustainable market moving on. It's a really interesting question, but unfortunately there is no answer because we're very much dependent on what's happening with the pandemic. For a very big, let's see what's happening with the jet fuel. Let's see what happened with the traveling restrictions. Immediately, people have started having reservations about traveling, about flying, about traveling. Whatever modes of traveling they had, they started immediately feeling a little bit less optimistic about that. So that immediately drew demand for product tankers down.
But hopefully, I mean, clearly the winter months are always months where you would expect, a seasonal uptick. But hopefully with the COVID, the pandemic becoming an endemic closer to the summer, we might see, the situation reversing.
It's very important. We're monitoring obviously the reserves, and but demand is the crucial thing here. And unless we see demand fully kicking in, we cannot predict what's going to happen in the near term. But definitely, it looks like that we're at the end of this pandemic, and hopefully by March, April, as everybody's saying, we will see a much better situation evolving.
You have made very specific statements about environmental regulations and their impact on the fleet. Can you tell us regulations like EXI or PTI, what impact can they have on the product tanker market?
Well, for us, I have to say that we have always focused on modern, eco-efficient, eco-mode vessels. So all our fleet complies. We have done the study, and we've seen that all our fleet complies with the new EXI regulations. Even our older vessel, the 2009 built vessel, we have already since 5 years ago, we have modified this vessel in order to comply, in order to have lower consumptions. So we have installed all the fuel saving devices in that vessel. So it is in a way complying with the new regulations coming in. And this means that it will be a very competitive vessel when the regulation kicks in. So I think we're fully compliant, and this was all along our aim to have a modern eco fleet, and that's what we have.
Eddie and Henry, another question that came in is, what would be the impact to the product tanker sector if Brent goes to $100 per barrel?
Well, that would obviously mean that demand is there, it's strong, and therefore we might see a scenario evolving. The one I have in mind is 2014, where the price per barrel was approximately 110 or 120, and the demand for that year was very good. It was a very good year for tankers. So I must assume that it will be a very good market, and we will have a very strong demand for refined product as well.
Another question that I guess Henry might respond to that is, do you have enough liquidity to meet your near-term obligations?
The answer is yes. And so let me try to address it from a couple of different perspectives. You know, at the ballpark amount of cash that we currently have on the balance sheet that's free is roughly a little bit over $4 million. We also have restricted cash that is required by our banks, part of our covenant package. That's a little bit over $3 million. In addition, we will be receiving upon the sale of 2 small tankers after repayment of that associated debt, as well as various transactional costs. Additional cash will roughly be about $2.8 million. So when you roll all that up, it's close to you know, $10 million roughly in cash, of which roughly $7 million is so-called free cash. So that's the first thing you should recognize. The second thing, and we don't provide forecast or estimates for the company, but I'll mention there is one analyst that has recently updated his model, and he's using a time charter equivalent rate for the MRs across the board this year of approximately $13,300 per day per unit. And as you saw from the presentation, the bookings for Q1 as of late last week were roughly 13.7, if I recall correctly. So we're roughly in the same neighborhood. And if basically that analyst was looking for 2022 for Pyxis to generate EBITDA of about $9 million. If you run through our interest expense based upon current LIBOR rates, as well as the scheduled principal payments and the dividend that is required to be paid on the convertible preferred stock, that runs up to about $10 million. So there's therefore roughly, exclusive of an improvement in rates, charter rates, roughly there's $1 million cash burn that would be incurred in 2022. So obviously in relation to free cash, that would be in the neighborhood of about $7 million. We're amply covered for liquidity purposes for 2022.
Thank you, Henry. Pyxis is a growth-oriented product tanker company. How do you expect to fund future expansion plans?
Well, as you've seen from the recent developments, we have utilized a combination of bank debt as well as equity capital from the standpoint of common stock and the convertible preferred follow-on. So we are dependent upon external capital sources to really fund the expansion of the company. So clearly, we will look to continue to utilize the capital markets when it makes sense. Obviously, at 40 cents a share and trading at a huge discount to NAV, we're not going to do anything like that in raising common stock. The preferred stock, we're comfortable at the level of preferred stock that we have outstanding, and obviously that works out well for the investors and ourselves. So I think you know, we probably for the near term are more dependent upon an improvement in the common stock situation before we would undertake further expansion of the company.
So we have 3 or 4 questions on the current stock price, and I will try to lump them in. Why is the stock price performing the way it is, beaten up? Is it entirely macro reasons, or are there any company-specific issues? And what catalyst do you expect that could move your stock?
So let me try to address that, and Eddie can obviously chime in. As I mentioned, our float of roughly 19 odd million shares is substantially held by retail investors. There has been, as you know, a risk-off sentiment from the standpoint of the investors obviously concerned about Fed rate increases, inflationary pressures, et cetera, et cetera. And so consequently, and that's specifically impacted small micro cap companies and growth companies. And so we have fallen into that basket. You know, the reality, our volume has come down to, you know, for it was consistently for many months, over 1 million shares traded per day. It's now roughly 300,000. So that reflects the fact of what's going on with retail investors. You know, I think that's primarily the factor that's affected us. I think investors, what they're looking for is a better signs of an improving chartering environment. It's great to see, you know, Stifel's research analyst put out an update on the tanker sector yesterday. And in that, he updated his model based upon what's been going on with Omicron, et cetera. His revised charter rate for this year for MRs is $16,500 per day, which is roughly $3,000 per day higher than what our current bookings are. And so we're hopeful clearly that would occur. He is looking for $17,000 a day in 2023. So I think what investors are looking for, and we're looking for obviously, is the demand to come through and therefore improving charter rates. That's going to really be a major catalyst for all of us. And so we're looking for that to happen. Supply picture looks really good from the standpoint of the product tankers. The question is the demand, and we just need to see better charter rates.
Yeah, and let me add a few things. I mean, all tanker stocks have been beaten up. It's not just PXS. It's, you know, all the tanker companies are trading way below their NAV. So it is a general situation. It's not just for the company. On the other hand, let me tell our shareholders, assure our shareholders that in 2021 we have done major steps to improve the company, and now in 2022 we have a new company out in Pyxis Tankers with a substantially better profile. We will be a totally pure play company with only MRs. We have sold the 2 small ones. Our financial position is much better, and our debt levels are much lower. Our break-even levels are much better. So we bring a totally new company in 2022, improved, and we're ready to take advantage of the improving market. This is what we are saying, and this is what we will continue saying. Continue to say in 2022.
I think, Eddie, you also answered the next question that had come in, that you know, was focusing on how do you differentiate yourselves from your peers, being a smaller size company, and what is the investment thesis in Pyxis Tankers? I think you opened the door for that. I don't know if you want to add anything more on that.
No, I just gonna repeat myself that we have positioned the company in a much better place, and in order to take advantage of the improving market in 2022, and do not have doubt that the market will be improving. It might not be this quarter, might be the next, but it will be improving within 2022. All the fundamentals look good, and we're really hoping that this pandemic starts to wind down, and we will see steady demand coming in and a sustainable market recovery, which we all need. This is when we will see also our stock price appreciating. And of course, we appreciate all the current shareholders which are holding the stock despite the beating that it has taken in the last 3 months, and really hope that they will continue to hold it.
So it's really a question of when rather than if, as you point out. So, sorry. So a concluding question, obviously on everybody's mind, it's the current share price and the potential of a reverse split in case we do not meet the continuing standards of NASDAQ during the extension period. When do you plan to look into a reverse split?
Okay, let me just address that. As everybody knows, we obviously put out a press release on that. We are in the extension period, which really runs through June of this year. We have to, if the share price does not get to a level of $1 at the bid price for at least 10 trading days, consecutive trading days, we will have to look into doing a reverse stock split. Obviously, we will do that in sufficient time in advance of that expiration date with NASDAQ so that we continue to list the shares on NASDAQ capital markets.
Thank you very much. I don't have any more questions. You actually got a very good number of questions and very good quality questions. So thank you very much for being with us today. Before I greet you goodbye, any concluding remarks from Eddie and Henry?
I think I've said my concluding remarks. We really have, just repeating, we have repositioned the company. We're just waiting for the good market in order for the stock price also to start appreciating. And let's not forget that we count on this stock price being appreciating in order to grow the company further.
And there we have a friendly, another friendly, this is one of the wonderful, occurrences when we do things on Zoom. So Henry, thank you. I don't know if you have anything.
No, I think we're all set. Thank you, Nicholas. We appreciate everybody's participation today, and we look forward to reporting hopefully much better news going down the road.
Thank you, Nicholas. Thank you all for attending.
Of course.
Right. Bye-bye.
To remind our viewers that this presentation will be available online for anyone who would like to come and access it later on. Thank you very much again.
Thanks.
And enjoy a snowy Athens.
Yes.